The translation exposure is the third exposure, which is which comes along with transaction and operating, or what we call economic exposure. So transaction is also called as contractual, operating is also called as economic, and then comes the translation exposure, which is also very critical exposure, significant exposure to the companies which have cross-border investment. This translation exposure we also call as many times accounting exposure, because actually this exposure comes when there is going to be some consolidation of the annual report, that is balance sheet or income statement of the subsidiaries into parent company balance sheet and income statement. So here number of times it happens that a multinational company which is operating all across the world, it may not be having only one or two subsidiaries, it may be having its operations scattered throughout the world, throughout all continents of the world. So in that case it becomes very difficult for the firm to convert the figures of the subsidiary or into the parent company's figure. Then there is also the issues related to reporting currency and functional currency. So reporting currency is that currency in which the subsidiary is operating. It has to report back to the parent company. And the functional currency is the primary currency, or the currency of the primary economic environment of the multinational company. So this mismatch of reporting and functional currency, it creates a lot of issues for a multinational company. And if we want to understand this translation exposure, we can take a very simple example, that if a multinational like Honda, which is having 300-400 subsidiaries scattered throughout the world, and also the problems related to difference in accounting standards throughout different countries. And apart from accounting standards, the accounting periods are also different. In some year, in some countries it starts from 1st of January. In some countries it starts from 1st of April. So then how the figures are going to be translated, or they are going to be under same common denominator so that they can be added or they can be compared? Because the issues they come up as, when we are going to convert the figures of host country balance sheet or income statement, the issues are at what exchange rate they are going to be converted. We are having one set of balance sheet income statement in one country or of one subsidiary. Now that balance sheet is balanced, total of asset is equal total of liabilities, and we have acquired assets, whether it is current asset or long-term assets, or liabilities, current liability or long-term liabilities, at different time periods. And the exchange rate which is prevailing in these different time period will also differ and vary. So at which exchange rate we are going to convert these figures into parent company balance sheet, so that becomes very important. And after conversion, it might be possible that the balance sheet may not tally in the reporting currency. So then there will be a problem. Like it might be possible that before conversion the working capital can be positive, but after conversion there can be a negative net working capital. So because of the adverse movement in the exchange rate or difference in the time duration at which the conversion is taking place of different items of balance sheet, we cannot use one common exchange rate for conversion of balance sheet figures of subsidiaries into parent company. Because like if we take example of assets, current assets we acquire during the year, like receivables, payables, debtors, and so many things are there in current assets. Similarly, like inventories, we used to place purchase order at different times of different duration of times. So when we are going to which particular rate we are going to use for showing their value at the time of purchase in the parent company. So that becomes a little bit difficult. Then if one subsidiary has measured its performance from 1st of January to 31st of December, and other subsidiary has measured its performance from 1st of April to 31st of March, then how to calibrate these differences, how to reconcile these differences and bring them in the balance sheet or income statement of the parent company. So this may lead to accounting, book profit or book losses. This is not actual, cash flow. This happens. Actual cash flow will happen only when the parent company or the subsidiary is going to dispose of the assets. Then actual cash flow will take place. But beyond that, the cash flow will not differ. So the what we call actual exposure will be there only when the assets are disposed of by the sale and purchase of assets they take place, and then actual cash flows are transferred from subsidiary to parent company, or the functional currency is or reporting currency is converted into functional currency. So in spite of that, the translation exposure, it may happen, it may lead to book profit or book losses to the company. And we know that the translation company or the multinational company, it needs to consolidate its balance sheet or income statement because of one very important factor, and that factor is that at various international level, at various forums and in various financial markets, when the company wants to take loan, it has to present an aggregate picture of its firm, of its business. So in that case, it is very important the consolidation of the annual reports or the annual balance sheet and income statement of the subsidiaries into the parent company, and then we get a holistic picture. So this translation, it poses a lot of problems. The one such problem is the exchange rate, at which exchange rate we are going to convert the figures of subsidiary into parent company balance sheet, because there are 200 currencies almost operating currencies throughout the world. So and a company is not having only one or two subsidiaries. It may be now conversion of these currencies into one single currency, and even when the assets are acquired at different time periods, there is difference in the accounting period or assessment period. So it becomes a very complicated process for the conversion of figures of functional currencies into the reporting currency. So for that purpose, various translation methods are used, like current, non-current method, temporal method. So there are one or two more methods, like these. Then monetary, non-monetary method, and then we have this one, which is the current rate method. So 3-4 methods are there which are used for the purpose of translating the figures of subsidiaries into the parent company. Now, when we go for translation, the different items of balance sheet and income statements are considered, because we have all different sets of current assets, current liabilities. Now in subsidiaries, the current assets are acquired at different time periods, inventories are required at different time periods, then receivables and payables are there. Then similarly we have current liability, items of current liabilities, then equity is there. There is one equity position in one currency, and when we translate the figure into other currency, reporting currency, then there will be a different scenario and at different time periods. And all these issues are posed by foreign exchange rate fluctuation. So this accounting related issue, it leads to accounting exposure. Due to translation of figures of the subsidiaries into the parent company, this is what we call translation exposure, which primarily is what we call book profit or book losses. So it is not having that much of significance like transaction exposure or operating exposure, which are in actual terms they result in cash flows. But in case of this translation exposure, they don't result in any kind of actual cash flows, but they may lead to accounting book profit or book losses. So as I just discussed, there are 3-4 methods of translation. Methods of translation, we call them like current, non-current, temporary, non-temporary, then temporal method. So these methods are used for the purpose of converting the figures specifically of balance sheet and income statement into the parent company, and then consolidation takes place. So for instance, current and non-current method, it explains that the assets which are of current in nature, like current assets or current liabilities, they are converted at an average of the exchange rate which is prevailing throughout the financial year. So that it can be a weighted average exchange rate, or it can be simply average exchange rate. So average exchange rate should be used for the conversion of these current assets and current liabilities. And in case of fixed assets or non-current assets or non-current liabilities, we should use that exchange rate at the time of acquiring that liability or the asset. So it might be historical exchange rate, like if the business has acquired a piece of land or some building, constructed some building, so the valuation of that building that should be done on the basis of the exchange rate of the year in which that building was started being shown as an asset in the books of account, and that exchange rate should be used, that historical exchange rate should be used for showing the value of that asset in the books of account. Similarly, so assets are categorized in the current or non-current, temporary assets or non-temporary assets. Temporary assets primarily the current assets or current liabilities, and then the current assets, and non-temporary assets like fixed assets. So various categorizations are being done, and in every method it has been emphasized that the assets, those assets which are temporary or current in nature, they should be translated at the prevailing exchange rate, that is during the year, and the assets which are of not of current in nature, like fixed assets or long-term liabilities, they should be the exchange rate should be historic, which should be used for the conversion of the figures historical. Similarly, in case of income statement items, they are of revenue in nature, so the current year exchange rate should be used, and a little bit it is impractical to use the daily exchange rate. On daily basis the expenses are being incurred, on hourly basis the expenses are incurred, so it is difficult to record those exchange rates. So it's better to have some kind of averaging of the exchange rate of the year, or you just use the exchange rate which was prevailing as on that particular date, and you can use that. So in case of income statement, same current method is also used. Now the ways of managing translation exposure. When we talk of ways of managing translation exposure, one very important thing is here. Many times translation exposure arise due to transaction exposure. When we talk transaction exposure, like if we are dealing in export and import, if there is no cash payment, then we are going to have receivables, and if we are an importer, we have to make payment, and we have not made payment, then we will be we have to pay. So we are erecting the payables in the statement. So receivables and payables, then if they will come, then of course translation exposure will be there. So many times transaction exposure leads to this translation exposure problem. So then second one is when we have conversion of balance sheet figures into income statement figures into parent company balance sheet and income statement. So every time we are converting, then these conversion issues lead to differences in the balance sheet figures of parent and subsidiary. The negative working capital can become positive working capital reporting currency, or positive working capital may become negative working capital in the reporting currency. So vice versa can happen. So just like in case of transaction exposure, the instruments which we use to manage them, so it's better for the firm that if transaction exposure is managed, then translation exposure can also be managed, because the translation exposure many times comes after transaction exposure, or due to result of contractual obligations between exporter and importer, translation exposure comes out. So if we are managing transaction exposure, then of course to some extent translation exposure is also get managed. Then we have balance sheet hedge. Balance sheet hedge, it means that if differences are coming in the asset and liabilities, for instance, if of the assets and liabilities of the parent company, they are balanced, they are equal, and of subsidiaries they are equal in another currency, but when we convert them into the parent company balance sheet income statement, when we go for consolidating those statements, then there is a problem, because the fixed assets are converted at different rate, then current assets are converted at different rates, and then we may have difference in the asset and liabilities in the reporting currency. So that difference can be hedged. That difference can be hedged through some derivative instrument like forward or options contract. Then we have the other issue is that even if we are going to hedge through some forward or options or futures contract, then we are going to speculate for it. Then we are speculating the future spot rate or forward rate. So in that way, it becomes very difficult for the firm to manage translation exposure, because here we are going to for forecasting of the forward rate or of the future spot rate when we go for hedging, when we go for employing any hedging instrument. So it's better that the firm should try to minimize transaction exposure, and let's have the translation exposure minimized due to decrease in the transaction exposure. So if transaction exposure is completely managed through various instruments, then it might be possible that translation exposure also goes down. And of course, the balance sheet hedge is also there. If differences are coming because of that, so some hedging kind of instrument can be used. So these are the ways through which the translation exposure can be managed. And we have discussed the meaning of just for a recap, we have discussed the meaning of translation exposure, why does it arise, then the methods of translation, and the ways to how to manage this translation exposure. Thank you.